Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our housing weekly market update. Hope everybody's doing well. Uh, I'm going to jump right in here and get into some of these details. We this week we had something that came up that Logan Motoshami over at Housing Wire was addressing, and that was let's see if I could share my screen here with you really quick. That was this stuff floating around about BlackRock. Now, first of all, it's actually Blackstone that was, the investor firm buying uh, the house, some of the investment properties and things like that. So that's the first thing I think it's important to kind of point out. Not BlackRock, okay? Two different companies there, but um, he had gotten into this and he said, it's basically misinformation, often confusing. And this was during his podcast. He said, confusing BlackRock with Blackstone, and the math simply doesn't work. Institutional buyers aren't the dominant force in the housing supply and demand. Usually, it's about 20%. Okay. As far as not what they're buying, but the whole, investor market. And then from there, at 20 to 30%, depending on your market, local area, all that. But a lot of it is really just the mom and pop stuff, the smaller investment groups that kind of make up the lion's share of that. But the idea, he says the idea that they can buy homes, and this was the thing going around over the weekend, and then double prices overnight is basically propaganda level nonsense. He also argues that ban investors, as they're called, talks ignore, the idea of banning the investors, uh, talks, ignores reality. He says people live in those homes and forcing mass sell offs would likely shrink rental supply and push rents higher, which would worsen inflation. Okay, makes sense when you stop and think about it that way. Um, the thing that really you got to understand is what really drove up the prices of everything, including housing, was first of all the spending that took place. Okay. And then we had a flood of immigrants that came in, right, wrong, good or bad. We had a flood of immigrants. So that increases your demand. You had super low interest rates at the same time. Okay. So with all that extra demand, and then you had not only low interest rates, you had super low inventory for housing. You had supply shock shortages during the pandemic years. So of 2020, 2021. So it was like a perfect storm. And then the Fed, of course, slammed on the brakes, did rate increases that, again, it's not a one for one with mortgage rates, but it does affect the bond market, 10-year Treasury, which affects the mortgage rates. And then it just made everything even more unaffordable. And that was the idea of taming inflation by doing that by the Fed. And also, uh, you know, the taming the demand that was out there, and it also was to put an effect on employment. That's their dual mandate is full employment and the inflation. But the big thing was inflation. The funny thing with Jerome Powell, which we brought up before, is everything was transitory until 8 days later he got his seat back. He was reappointed by Joe Biden, and then it wasn't transitory anymore, and that's when the rates started going back up. They started raising the rates. And then of course last year, when the economy really didn't make sense to lower rates even at that time with the higher inflation we had, but he lowered rates right before the election, which again is something they normally don't do, so that they're the independent Fed, and so on. But anyway, on this BlackRock thing, um, he said, and there certainly was a lot of the iBuyer thing going on. Of course, we had to work with them on both sides of transactions here in the valley in the greater Phoenix area. That was certainly a factor out there. No doubt about it. They were definitely buying things, but it wasn't kind of the whole catalyst for all this, and there was other factors involved. That's all I'm saying. So, second, he says the real story is, it's happening in housing right now, um, is that the demand has improved to near 3-year highs because the 10-year Treasury yield fell and the mortgage rates eased. Okay, so his tracker, which we'll take a look at in a minute, combines multiple live indicators: pending sales, purchase applications, which are super important. We're going to get into all this: inventory, price cuts, and mortgage spreads to show demand responds when mortgage rates get roughly, in the mid six range or lower towards 6%. And that's when Jerome Powell, Neil Kashkari, some of the other Fed governors, they get a little worried because they think, if rates go down, then we're going to have, this flood back into the market, and it certainly will increase demand. For every 100 basis points, we could see 5 million more people come into the housing sector. But a lot we had a lot more inventory this year, which we've talked about, but it's coming off of historically low sales levels. Okay. The NAR is predicting that next year we'll see a 14% increase. Realtor.com thinks basically from interest rates to the number of sales and everything else, that we're going to basically see the same thing we saw this year. Okay. I don't agree with that. And from listening to what President Trump has talked about, some of the other people who are in the running to be Fed president, the chairman of the Fed, after Jerome Powell leaves in May, um, and the Fed just cut rates again, 25 basis points. And he actually didn't pour cold water on that, which was amazing. Couldn't believe it. But he basically admitted the same things we've been talking about. Inflation's down, but the tariffs, may be still coming through into the early part of next year. I doubt that's going to really have any impact. The most it could have is a one-time price adjustment of like 0.2 to 0.3%. GDP, the numbers that they're coming up with are much lower than the projections that President Trump and his administration are seeing in the numbers, with capex coming on board, and everything going into next year. I think we're going to see what we've been seeing right around now, and that's around a 4% GDP next year. But he said the big news, again, we've been mentioning this again, is labor over inflation is what they're really tracking. And he said, we really have seen a lower number of jobs coming on, and that's a problem. We talked about this last week. 32,000 minus 32,000 jobs coming on track uh, was the latest data we had. And they were hoping for a plus 56,000, so that was way off. And we see that the average CPI overall aggregate data shows about 2.5%. Now, if you look at the now data, it's going to be closer to two, because of the shelter costs that they're still getting caught up with. That's kind of starting to filter in, which he talked about last time and this time a little bit. But their mandate's not housing. That's not the mandate that Congress gave him. He doesn't care about housing as far as Jerome Powell and the Federal Reserve goes. But anyway, he'll be gone in May. There's another Fed governor leaving in June who's another hawk. And I think that we're going to see an entire restructuring of the idea that we're not going to be getting penalized for doing well, from everything from taxes to the economy. When GDP goes up, and you have a little bit of inflation, we're going to see the whole restructuring of the economy, basically. And that's what we're seeing with the trade policies, with the tax policies. I don't know if we'll ever get there. President Trump is talking about no income tax. I think that would be wonderful, but we'll see how that all shakes out with the spending, as opposed to the tariffs and what we're doing in taxes. But anyway, I think next year, once Jerome Powell is out of there, because he's only calling for one cut next year, 125 basis point cut. That's absolutely nonsense. We are already behind. We should already be at a neutral policy. We should already be closer. Right now, we're at 3.5 to 3.75. we should already be for the Fed fund rate. We should already be at 2.5 to 3, which would be more of a neutral or lower neutral policy. Um, and that's what a lot of, like Kevin Hassett, Stephen Myron have said. Barry Habib, who's four-time crystal ball winner, we like to quote him. Logan Motoshami, also at Housing Wire, who I'm talking about, giving us this data right now. So a lot of other economists have said, this is what is really holding back the economy unnecessarily. So because the shelter costs will come down, that makes up a third of your CPI inflation. Okay. The PCE, it makes up about 16 to 18% of that. And that's really what the Fed tracks more of. But even Jerome Powell is admitted that, that's lagging, he calls it. And it does lag. It lags for a year to 18 months. But if you look at that, it's already much lower on the shelter costs. Um, so when you take it all into consideration, not to get lost in the weeds of that, the right now inflation is closer to 2%, but using their lagging numbers and the aggregate data, it's about 2.5 for the CPI. So um, third, Logan Motoshami says that that rolls into the Fed. So the Fed meeting, he acknowledged the deterioration in the jobs data, which we just talked about, calming the markets, pushed yields down on the 10-year Treasury, helped mortgage rates, of course, over time, along with the spreads between the 10-year and the 30-year mortgage rate. So there's no the Fed there's no appetite for hiking rates, and he expects disinflation next year, especially from rent services. So the bottom line is rates from here, depending mostly on labor data, especially jobless claims and the housing market. Best cases, according to most economists, think it's going to just hover around 6%. I think they're going to be lower. And I'm going to show you something in a minute. You're going to see rates are already lower if you're working with the right lender. I'm going to show you the actual rates for this week from our preferred mortgage broker. Okay. Um, but that'll build momentum in the housing market, and that's why we're seeing demand come back. Okay, that's why we're seeing demand come back right now, because it's been a sustained period of time with lower interest rates. Okay, so diving into this a little bit more, December housing demand near 3-year high as spreads improve. 18 weeks of rates below 6.64% have delivered double digit year over year growth. Okay. So a summary here is mortgage applications reached a 3-year high as improved spreads between the 10-year and the 30-year kept rates near 6% for 18 weeks. Inventory growth slower, price gains also supported stronger buyer demand in late 2025. So we had a shift in the summer where basically rates went lower because the spreads got better over the year, and then we saw these rate cuts, and the bond market already priced them in ahead of time. But we saw these rate cuts and the bond market be getting ahead of that, but we saw that bring down the 10-year Treasury, which brought down the 30-year mortgage rate. So but we need these lower rates for a sustained period of time to bring demand back, and that's basically what we've had for about the last 4 to 6 months. All right, so that's great news. But we've also had a lot of people seeing this, and then they put their homes on the market late in the year. Okay, so we also saw that over the mid to late summer, and a lot of people thought, well, great, I'll put my home on the market. Homes weren't selling as fast as people wanted, though, because we had this additional inventory. Now, nothing crazy. We're just back to pre-pandemic lows. We're right around 1.5 million. But mortgage application data, the last 3 years has shown that mortgage rates fall below 6.64 and head towards 6. Purchase application data improves, especially week to week, in the past few years, we weren't able to hold the rates down near 6 long enough for the real retraction. This year, we have been able to hold the rates below that 6.6 for 18 weeks, which has been the best 18 weeks of the year. Below is what the data has shown us for the last 18 weeks. 11 positive week to week prints, 7 negative week to week prints, 18 weeks of double digit growth year over year. So we can see that on the chart here. And going into December, uh, we had that positive print. Now we did get a negative print this week of, I think it was 4%, but we're also into the holidays. Okay, so total pending home sales um, going into December right here, we're at 324,000. Last year we were at 293. So that is improving. There's more buyers coming back to the market, in other words. So the spreads between the 10-year Treasury and the 30-year, he's forecasting, Logan Montashami's forecasting between he forecasted for 2025 between 5.75 and 7.25 with the volatility that was expected, fluctuating between the Fed's fund rate of 3.8 to 4.70. That was pretty much where we started. Now we haven't gotten down to that 5.75 according to the national average, but I'm going to show you some stuff that's pretty interesting here in just a second for our local area. Okay. Um, so he says, basically the mortgage spreads mattered so much between the 10-year Treasury and the 30-year. We can see how they dipped down a little bit, went up a little bit, but it's been pretty much holding in that lower 6 range since summer. So that's good news. Mortgage spreads have really been the story though, because he was looking for this improvement in the spreads. If he says if today's spreads were as bad as they were at the peak of 2023, for instance, rates would roughly be 0.99% higher at 7.26. So that's just from the spreads, okay? Conversely, if spreads return to their normal range, mortgage rates would be 0.51 to 0.31 lower than today's level, meaning they would be 5.76 to 5.96. So that's how important the spreads have been this year and going into next year. And we can see that they've definitely improved over time. But right now we're at 2.11. We should be between 1.6 to 1.8. Okay. That's the new historic average. All right. So healthy inventory growth, that's also been the story of the year. Logan said, he wanted to see more than last year in the last couple of years, and since the pandemic, because that was the other issue with the pandemic period of time. And we've got 15.26% more than last year. Again, this is across the country, guys. Okay. I'll get into the local data in just a second. So that helped to stabilize pricing a little bit with that extra supply, even though the second half of the year demand has come back now here recently because of the lower rates for a sustained period of time. So percent of properties with recent price reductions, all right. We've had price cut percentage at 40%, all right. And I think a lot of this has to do with aspirational pricing of a lot of sellers. People think it's 2021. It's not 2021 anymore. We've got more inventory. We had higher rates for that longer period of time. Affordability has been stretched, even though incomes have gone up. They haven't gone up enough yet. Over time, we've got to have that equilibrium come back into play. And the inventory's definitely helped with that. But we've definitely seen price reduction. Is this a crash? No, it's not a crash. Okay. It's not a crash. So basically what we're seeing in a lot of areas, except for the Northeast, which has actually had a little bit less inventory up until lately, because they're catching up with what's going on with their demand. They had less inventory, less building going on, more regulation, more taxes, things like that. Harder to get those permits for a new building, uh, mainly because they don't have as much land as we do in the South and in the West. But 40.2% price reductions. So um, when we look at last year, we had 37.4%. So, but what we haven't had over the last, since around spring of 2022 is this lower rates for a sustained period of time and trending downward. Okay. And I think over the next year, once we get through the, Jerome Powell's reign of terror, and some of the other Fed members leaving, they don't all vote, but we got 12 of the governors vote on these board on this board, but there's actually a total of let's see, 18 of them. But we're gonna see, and there's a lot of dissent. Stephen Myron wanted the 50 basis point cut this time. He's been calling for that the last two cuts because he feels like it should be in that lower range that we talked about, but. Uh, he says the week ahead. This was actually a little bit earlier in the Fed meeting, so we already know what happened with Jerome Powell and the Fed. Now, let's take a look at this. So, I want to show you where the rate you can actually get without any buy downs or arms or anything like that in just a second. But look at this. So we ended up at 4.19. We had some of this lower end stuff, and then the 10-year Treasury bounced back up a little bit. I think once we get caught up on some of the labor data, which Jerome Powell is actually calling for 4.4 for next year on the unemployment rate. So we'll see how that shakes out, because that was the point which we've already hit a couple of times where he said, well, we get near 4.4, 4.5, and what you really are going to need to see for some dramatic cuts is 323,000, at least in Jerome Powell's mind. So if we ever did get that, even though we've got very weak new jobs numbers, which he is acknowledging finally, um, even though he was, I think he had to eat some crow there. Some of the other Fed governors have just been terrible. I can't even think of her name right now, but uh, some of them should just be fired. But they were saying, "Oh, the labor market's fine." I don't know when these new job starts have ever been fine, where we've got such low numbers, but we got caught up on all the fake numbers we had. Remember, we had a million that was revised earlier this year. It was insane from the numbers from last year. So just crazy stuff. But this has left us with the average across the country of the 30-year fixed at 6.32% today. Okay. Now, what I want to show you is what I love, and that is our local mortgage broker. And I mentioned this to you before. Our local mortgage broker, this is his rate for the 30-year fixed right now. Obviously, it's, with a good credit score, 5.6%. So not every lender, not every loan officer is created equal, just like not every realtor is going to be created equal. And look at the FHA for first time home buyer, 5.125, VA 5.25, and your jumbo, of course, at 5.7. So look at those rates, guys. That is way different. And it has to do with pricing, it has to do with the fees involved that some banks or lenders will offer. Now, when you're dealing with a mortgage broker, just in general, you're probably going to see lower fee structure, lower APR. Okay, these deal with the fees. Okay, um, but you're gonna see a better rate. But with our lender, their fee structure is pretty much at the lowest end it pretty much can be, and they're typically throwing in an appraisal with that. So that may save you around 600, $700 or whatever, your appraisal is going to be. So that makes a big difference for any buyer, but especially first time home buyers, guys. FHA, VA. All right. So I want you to know that this is without any buy downs. Now we can negotiate buy downs with a seller. They're paying to buy down your rate. Builders are offering a lot of incentives, and the builder market is really kind of a separate market because of that. I mean, they're offering rates, fixed right out of the box between 3 and 4%. Down payment assistance at 5.75. I heard this week. They're offering 3-2-1 buy downs where your first year is 1.9, then second year 2.9, then it's fixed at 3.9. You still have to be pre-qualified at the higher rate where you're going to end up fixed at that 3.9. But a lot of them are offering those buy down rates. So you can get a lower rate now. Okay. Again, we can negotiate these rates down from sellers too. So wanted to make sure you saw that. Simplify Home Loans with Andrew Fisher. He is a VA specialist and a Marine reservist. So definitely something to keep in mind there, guys, so that you know what's what. Now, with this extra demand coming online, I wanted to, point something out. Is there going to be a crash? No. And here's why. Here's the big reason why. When you had the crash, first of all, you didn't have pre qualified buyers. Number two, people didn't have a lot of equity back then during the crash. Right now, your average homeowner, 40% of them owns their home outright, a little over 40%. Okay. And about half of them have about $300,000 in equity. Okay. That's a giant padding. In other words, if they did get in financial trouble, they could take out a HELOC. Okay. They could do a cash out refi, whatever. So there's that. They could sell and move on to something that's less expensive if they ran into an issue, right? It's very, very different. And then you look at the inventory levels across the country. You're right up at about 4 million homes. You had 250 to 400,000 homes coming on the market for about 4 years or more. So now look at that difference in the inventory. Okay. So super important to understand this in the greater Phoenix area. I'll show you the numbers in a minute, but back then we had about triple the inventory that we have right now. Okay. So no, we're not in for a crash. Okay. We're just not in for a crash. And we've got Logan, some of these people won't debate him, but you can see through the years all these headlines for clickbait. Okay. And Logan says, if anyone fell for this chart that Nikki published for years, have a Merry Christmas. So, and he will not debate Logan Mohtashami. And like Logan Mohtashami says, these people do not have working models. They're not economists. They're not housing experts. They're just podcasters, trying to get clickbait to make money. So, um, here's another guy that you'll see out there. Housing crash. This was 2 years ago. Um, you know, there's a lot of these. There's a lot of these out there. This is just 2021 housing crash. Yeah. Okay. All right. Yeah, it's coming. It's coming. It's coming. Ever since the last crash, it's coming. Okay. So, anyway, it's just interesting. Unfortunately, the mainstream media doesn't do a very good job at this too. I've shown you charts before going back, 10 years. Diane Olick on whatever media she's on, some of these other ones, they just don't have the correct data, or, it's a matter of they're just doing the clickbait thing. So, yeah, it's very interesting, guys. I just thought I'd share that with you because I enjoy it. I think it's funny. So hopefully nobody's fallen for that, but unfortunately there are a lot of people falling for it. So, anyways, getting into some of the other data here. We've got the 82 day. This is for the greater Phoenix area now. 82 days closed on market. Okay. That means if there was no other inventory that came on the market in 82 days, it would basically, in theory, be gone. We've got or I'm sorry, 82 days is how long things are sitting before they close. 4 months supply, that means if nothing else came on the market, um, we would basically be, out of inventory in about 4 months. Now, under 4 months supply basically puts us back into a seller's market, maybe a slight one, but if we just are just under 4 months supply, that basically tells us we're in more of a seller's market. Absorption rate is up at 24.75%. It's gone up a little bit. Now, what a lot of sellers have been doing too, think about this. A lot of people do delist normally. Okay, it's not anything that's out of the ordinary for people to delist um, during the holidays, especially if, obviously if their home didn't sell, because they got things going on, family stuff, holiday get-togethers. They don't want to deal with showings and everything, and they just figure, well, you wait to 45 days, you re-up, you go back to zero on the MLS, as far as your days on market, and start over. So a couple of strategies there for you really quick is, maybe during the holidays, if you can, stay on the market, because now there's more buyers, especially during this time while buyer activity is going up, even in the Phoenix area, which I'll show you in a second. Uh, your home will stand out even more if there's less listings, right? So that's one strategy. Or, maybe, if you look at I showed this last week, but if you look at the data, usually everybody puts their home on the market here in the Phoenix area around March. Unless you're in like Sun City, you're probably putting your home on the market, around now or in January. And that's when the buyers start coming in after the holidays, spend time with the grandkids and all that, wherever they're coming from. But for our winter visitors, but just, to think, maybe instead of doing that where we see the inventory start picking up again in March, typically, maybe you do that in February, okay, or January. Again, doing what the rest of the herd isn't doing usually creates success, like in investing, and that's where we see people, making those moves when other people aren't. Average list price 762,000. Average sales price is 657,000. That's definitely up. The list to sales price ratio, basically when we look at a lot of these numbers, where our home price is up or down. When you take a look at it across the country and in the Phoenix area, in a slower year like this, your average in the Phoenix area is going to be about 4 or 5%. Okay, normal equity gain per year since the 80s. Across the country, it may be 2, 3, 4%. Now, when you take that into consideration with inflation, especially in a slower year like this, you may see, with inflation, it's kind of a wash. In other words, it kind of flat. It's kind of neutral. Okay. But remember where we've come from. People still have a lot of equity, so it's not a crash. It's not a crash. So anyway, it list the sales price ratio 97.11. So people who are listing their homes are giving up right around almost 3%. Usually we like to see that number closer to about 98%. Inventory. Active inventory right now is negative 1.1. During the holidays, we're still at about 24,660. Uh, the new listings that came on, though, which means there's still activity out there, is actually new listings for the week is actually up 46.2%, 1667, because people are seeing what I just said. We've got demand coming back, all right, and then we've got more people thinking, well, I'll put my home on the market when other people aren't. Now, the pending sales data is down, but I'm going to show you in a second. Year over year, it's actually up. Okay. We don't see anything really weird or strange going on in the distressed market. As a matter of fact, it's pretty normal. Okay, HUD's way down, but short sales, lender owned REOs, nothing crazy happening there. We've got closings actually up 6.8%. And then you can see deceleration in these red areas for these price brackets here, as far as the number of units. And these are the days on market here listed. And you can see the change in the number of properties for sale. Again, time of year um, for those delistings, all right, in those price brackets. And we've actually see 68.07% up from 0 to 600,000. Okay. And from 600 to a million, we're down 18.57% as far as the number of listings, and over a million, down 13.36% as far as a deceleration. So, interesting stuff, though. If we look at where we are right now with new listings, compared to this is last week. Okay, we're actually up about 500 homes. Can actually see here where from last year we're almost the same, but up a hair, and the year before we're up, over like 240 homes more were listed for sale. If we look at under contract this week compared to last week, we've got a little less. Okay, makes sense. But when we look at the year over year, look at that. We've got for under contract, we've got 300, a little over 300 more, and the year before, we were at 2746 versus 3379. So we're seeing more properties come under contract, even with higher inventory levels this year, and more listings going on the market right now this week. So, sellers and buyers are pretty active. We're seeing, more buyers in the buyer pool than we had last year or the year before. So, pretty interesting numbers there. But again, it's those lower rates for a sustained period of time. Um, Price reductions too, but that rate really makes a difference. I mean, we're talking, you know, 250 to $300,000 in a 100 basis point difference versus, $10,000 price reduction is only going to give you maybe 80 to $90 difference in price. Compared to that, it's a big difference. So um, we could see that the um, well, let me just switch out of this. Okay. So when we look at the Cromford Market Index, this is actually up. This was in the 70s. Okay. So the Cromford Market Index will tell us, um, you know, between 90 to 110 is a balanced range. At 100, we're at a completely balanced market if supply and demand were the same number. Right now, our demand then is down, about 26 uh, or 16 points from 100, and supply is up 2 and 2.6 above a normal supply amount. So right now we're in a buyer's market because we're below that 90 mark. Okay. But I think we're going to see, right now that, the key takeaway would be Phoenix looking stable but tightening. Inventory is still higher than last year. Yeah, month supply is falling, but pending sales are up, which, month supply is falling, but the week to week went up, right? So, which points to a market that could drift back into a seller's market. So, looking at some of the percentages here, uh, you know, the let's see, what did I have here? I had a note here for this. New listings up from the last 2 years is up 13% more inventory. Okay, so we see days on market active at 92, and days on market closed at 82. So It's going to be interesting going into the new year, guys. I think what we're going to see is a lot more inventory coming on the market. But guys, can you believe we're going to see more inventory, but we're going to see more buyers coming in? But can you believe where'd that go? These rates. I mean, they are incredible. Those rates I showed you, 5.6 for conventional, FHA 5.1, and VA 5.2. I mean, that to me is just I couldn't believe it when I saw the latest numbers. So it's important to know that you're working with the best. Make sure you reach out to us if you have any questions, even if you're just curious about your home value. What we like to do is, come in, do a quick 10 to 15-minute walkthrough, even if you're a year or two out. Okay, do a 10-15 minute walkthrough, kind of give you an idea on your condition updates, get an idea there, because Zillow isn't going to tell you that. Zestimates are off because they don't have people walking in the door. So I want to see condition updates. I'm going to give you a today a 3 options on pricing strategy, give you a real comp package. In other words, the actives in your area, the under contracts in your area, and what the trend is there right now. Okay. That's going to be super important. And Zillow isn't going to tell you that. Okay. Along with the condition and upgrades. And then, get into that, and make sure that we're really looking at the hard numbers. Okay, because it's super important, to know that, and then give you a net sheet. Okay, and then you know where you are right now, and whether you're going to do it now, we can keep you up to date, monthly, and by the quarter, where things stand. So if you're looking at doing something, in the next, month or two, if you're looking at doing something in 6 months to a year or 2 years, we can keep you up to date and have that starting point on where things are, and then get into the details from there. And when you are ready, about 90 days out, then we'll want to get going on that. On, the purchase, we want to make sure that, where you want to move to, we've got everything dialed in there with the lender. Obviously, putting together a strategy there to find you the right property, and even giving you access to off market deals that we have access to that you're not going to see anywhere else. So, guys, feel free to reach out anytime. You can always call direct, text direct, or email us, book an appointment for a quick 15-minute strategy call, and then we can kind of take it from there too and go that route. So hope you have a great weekend, and make sure, oh, I've got, actually, let me just share this with you. I've got, I want to share, there are some events going on this weekend. Okay. So here are the events. I'll make sure I send this out to everybody who's on our mailing list. But it's kind of a great time of year. People get a little bit more time off. Want to know what's going on. So there's a quick look at all the events going on right now. And then we have an open house coming up, an open house event coming up in Cooley Station in Gilbert, Arizona. That's going to be this Saturday, tomorrow, the 13th, from 12 to 3. Okay, so be sure to check that out, guys. And if you have any questions at all, we'd love to be able to help you out. Thanks a lot. We'll see you next time.